Chris, thank you for joining us today. So what
Thanks,
happened?
Leslie.
Was it technicals at play, fundamentals at play? Why do you think we saw such a dramatic bounce intraday?
Well, I think certainly the psychology of NASDAQ being down 20 at the lows likely set off stops. We went into the day, frankly, pretty oversold. At one point this morning, we had as few as 15% of the NASDAQ 100 left above its 200-day moving average. So these are all conditions that can conspire to get you some type of an interim low or a tactical low. But I think what people need to remember is there's a lot of damage and a lot of broken charts out there. And even a 15% rally from here in the triple Qs really only brings you back to the now downward sloping 200-day moving average. So that is damage, I think, that will need to be repaired over the course of the year. And I also think we need to remember when we talk about tech and we talk about the Qs, I mean, tech has been topping relative to the S&P for the better part of the last 18 months. So tech and the Qs went into this correction not as leaders, but as laggers. And I think that adds to the burden of proof that we're going to need to see to say any rally is the real thing going forward.
So, Chris, do you think at these levels the Qs are looking oversold? Do they have further to go?
Yeah, I think it's certainly reasonable, that we've seen enough of a flush for some type of an interim low. But, you're going to run into resistance here. And that's not a word that any of us have had to use for 2 years, this word resistance. A lot of these broken charts have a lot of resistance now on top of them. And I think what's been most remarkable about particularly some of the big weights within the Qs is the analyst community really hasn't changed their opinions on them very much. If you look at the top 5 names in the Qs, many of them, Amazon, for example, 57 of 57 analysts who cover it still have a buy on it. Google, 51 of 52 analysts still have a buy on it. So I think the street needs to change its impression of some of these names before I would be comfortable saying that we've done enough to flush these for them to return back to the old highs.
Chris, a lot of people looking at 38% retracement of the bull market on the S&P would put you somewhere in the 3,800 range. I wonder if you think that makes sense and especially how you're viewing fear on the S&P right now.
Yeah, Carl, it's a great question. It's funny how ancient math really comes into play here sometimes. I think that's an appropriate target, not here, but maybe over coming months. I want to reiterate, I do think we've done enough in the short term here to get some type of a response, and perhaps we're seeing the beginnings of that today. What's struck us a little bit, though, is we would ask, is there enough fear out there, though, to put in a major bottom? And that's where we're a little confused. Frankly, the put-call data, which you tend to see spike at some of these good interim lows or good market bottoms, really has not spiked here. So you have not seen the stress in options that you typically would want to see. So I think we've done enough for a tactical low. I think we can get a pretty good bounce here. But there's resistance on top of the major indices, and that's not something that we've had to contend with for a long time, Carl.
So do you think there's more fear to come then? Am I reading that correctly?
Yeah, when you look at all the survey data, the sentiment work, it started to move in the direction of fear and anxiety. But I wouldn't call it flush, and I certainly wouldn't call it of the same category as what we saw in, say, March of 2020 or even December of 18, which were similar drawdowns in terms of percentage, right? So I think there's more to go. Watch the put-call data. That's about as good of an indicator as we have, looking back over the last 30 or 40 years, engaging when the anxiety or the stress in the options market is so pronounced that a major low is likely in.
That's good stuff, Chris. Appreciate it very much. Always good to see you, Chris Verrone.